Okay, hello guys. Today we are going to practice the lessee accounting for capital lease with bargain purchase option, followed by the guaranteed residual value that we practiced in the last the video clip. The difference between two the cases is that the guaranteed residual value, the lessee should uh, return the capital lease asset at the end of the lease term. So their depreciable years of the capital lease asset is 3 years with the non-cancelable lease term. But the bargain purchase option means the lessee will purchase this asset at the end of the lease term with a very cheaper price. That means the bargain purchase option, right? So the lessee will still be having this asset on their balance sheet. They continue to use this asset until the end of the useful life, not the end of the lease term. Okay, so keeping that in mind, let's jump into the question. 3 years non-cancelable lease initiated on January 1st, year 1 for equipment with 5 years expected life. So you should consider that what is the depreciable years of this asset, because the lessee should depreciate this asset because the lessee will take this asset on their balance sheet, right? When they use this asset, they should recognize the depreciation of this asset. Okay. And number two, the 3 annual 50,000 lease payments are due beginning January 1st. January 1st. That is the big difference between two cases. The previous one, the payment takes place December 31st every year, but that is the beginning, right? So you should consider this is not the ordinary annuity case. This is annuity due starting the payment from today, right? The lease can exercise the bargain purchase option with $10,000. That $10,000 also a part of future cash flows, future value of this minimum lease payment. So when you calculate the present value of a minimum lease payment, you should discount this value as well. Next, the fair market value at the inception was $145,000. So if the fair market value is lower than the minimum lease payment we will calculate, then we should put this number, this amount. But if the minimum lease payment, present value of minimum lease payment is lower than fair market value, we will use that value. And the residual value, $2,000, when we depreciate this capital lease asset, then we will apply this $2,000 in the depreciable amount. Okay. And the lessee's incremental borrowing rate is 10%. The lessor's implicit rate is unknown. So, okay, this is only one the discount rate we can use right now. And then present value of 10% ordinary annuity is 3 years. Okay, 2.48, which is the same as this number. But we cannot use that factors right away because that is ordinary annuity factor. Then how can we convert this factor into the annuity due factor? That's right. The ordinary annuity, the payment started every end of the year for 3 years. But in this case, we pay this payment as a lessee pay the every beginning of the year. So every future cash flows should be taken back by 1 year, So we multiply 1 plus the interest rate to this the annuity factor. By doing so, we can take back all the future cash flows by 1 year. Okay. And then 10% for 3 years. Present value, this is one-time present value of future cash flows of present value, and factor is 0.75, right? We'll use this factor to discount, right, the bargain purchase option $10,000 future cash flows. Okay, so depreciable years, how long years of depreciable years of the capital lease asset? 5 years. Okay, the useful life, because lessee will hold this the capital lease asset for the useful life with bargain purchase option. The capital lease obligation, now let's calculate the $50,000, the lease payment annually times 2.4869, the ordinary annuity factor, but we are not using that factor right away. Instead, we take back by, 1 plus 10%. And then we can reduce the discount by 1 year for every future cash flows. Okay, or you can just simply 1 plus 1.1. Okay, and then $10,000, which is the bargain purchase option at December 31st, year 3. Then times, right, this is a one-time the future cash flows with this the discount factor, right? So that is the capital lease obligation at inception that shares with the capital lease the asset amount. Number 3, the capital lease obligation, the non-current portion, we will calculate this one after we finish the journal entry work. Okay, let's start the journal entry work. Okay, now it's very easy, right? We already covered this exercise before. The capital lease asset amount is the same as the capital lease obligation amount. And then, what is the first transaction at inception? Right, cash payment started from today, $50,000. And then by that amount, we reduce capital lease obligation because we paid, right? We paid. And then in 1 year, we need some adjustment, the transaction. Adjustment transaction means there's no actual transaction, the physical transaction, but we should recognize, right? Like interest, even though we don't pay any interest payment, we should recognize at the end of the year when we close the book, right? Or depreciation is not the actual transaction, but we should recognize the depreciation because we use this asset, right? So we follow accrual base or the actual business, the business transactions and the accrual basis or deferrals. All those things are the adjusting the journal entry. So interest expense, we need the principal, right? Principal of our liability, and then we apply 10% on it to calculate interest expense. What is the principal of the liability? Okay, capital lease obligation minus, we paid that amount, we reduce that amount, and then 10%. So 9,429 is interest expense. But do we pay this interest expense on December 31st? There's no any payment. The payment takes place, the recurring every beginning of the year, right? But anyway, we should recognize at the end of the year to close the book. So we should recognize interest, right? Interest payable, which is cash to pay, right? Instead of recognizing cash to pay, also the interest payable is obligation to recognize at the end of the year, which is the same amount. And then we should recognize depreciation expense because we used this capital lease asset. Then what is depreciable cost? Capital lease asset value minus, where is the residual value $2,000. Here we go, $2,000. That amount is residual value divided by 3 or 5. 3 or 5, right? 5 years. Why 5 years? Because again, this the transaction, the lease, the contract has the bargain purchase option, and then lease can exercise this bargain purchase option, $10,000, right? So we should depreciate 5 years with the economic useful life of this asset. So we will depreciate this amount every year. Okay, so in order to use this, then here accumulated depreciation to reduce the value of original cost of a capital lease asset, which is the same value like this. Okay, then finally, very next day, the lessee should pay the second payment, right? Second payment. Which one is easy one? Okay, cash out is $50,000. This $50,000 is comprised of interest expense of this, right? But we already recognize interest expense. And then when we pay cash, this cash is including this interest expense, right? Then we just get rid of this interest payable, right? Because we paid this $50,000. Then what is the difference between this, right? The cash amount, the cash payment, $50,000, contains interest and principal, right? So capital lease obligation is now the $40,571, right? So we can fast calculate the current liability at December 31st, because the current liability portion of the current liability, the capital lease obligation, is the amount less than 1 year mature, right? So the 40,571. What is total amount then? Total amount, we started from principal minus capital lease obligation reduced and capital lease just this, because we are constructing the capital lease obligation balance sheet December 31st. Okay, so that's it, 94,250, right? And then what is the non-current portion of this capital lease liability, the obligation, is we just subtract. You can just plug in, right? Okay, so what is the answer? Answer is number 3 answer. We got it. Okay, then what is the second end of year? So we will use the same account, right? It's same account. The interest expense now, interest expense. How do we calculate it? Okay, so this capital lease obligation minus capital lease obligation paid minus capital lease obligation, the second principal paid, times 10%. So 5,372. So that also, we do not pay this interest expense at the end of the year, but we should pay this amount. That is our obligation. So interest payable recognized. And then depreciation expense, one more time. Oh, by the way, maybe that way is much better. We want to fix this amount for, okay, by doing so, when I copy and paste, okay, we got it. Next, the payment in the very next day, also same process, $50,000, third payment, and then interest payable, which is this amount, right? The same amount of interest expenses, right? So by 44,628, we reduce capital lease obligation one more time on the that is number 1 to 3, third payment, right? Third payment. Then let's create the balance sheet on the December 31st, year 2. The capital lease obligation, the current liability portion, is the 44,628, because very next day the lessee should pay this amount, which is their obligation within 1 year, right? And then the total amount of capital lease obligation at the end of December 31st, year 2, how much is it now? How much is it now? Right, we have had this and minus, then this amount, and then we come up with this. Oh, somebody already write down there. And then the non-current portion is 9,091, right? Then let's finish up the final transaction. Interest expense we should recognize. Interest expense. Okay, and then the cash. Why do we put cash? Because there's no longer payment, because third payment is done, right? But why cash? Right, the lessee exercised bargain purchase option with $10,000. This $10,000 bargain purchase option, but that bargain purchase option, $10,000, should include some interest expense and the capital lease obligation, right? So interest expense. Let's calculate interest expense one more time. How do you calculate it? Okay, one more time. Total amount, current liability, the capital lease obligation minus 50. Let's subtract all the capital lease obligation, which is the principal amount, and the 10%. Then 909. And then what is capital lease obligation? Okay, 9,091. Oh, I remember this number. Where was it? Okay, this amount should be the same, right? Should be the same. At the end of the day, the total amount of this capital lease obligation should be 0 when we get rid of this amount, right? And then finally, right, depreciation expense, because we use this asset, right? So one more time, this is 40 year, right? So current liability portion is this amount, but as I mentioned, this amount should be gotten rid of, right? So 0. We don't have any non-current liability for capital lease obligation, and then total amount also 0, right? And then finally, capital lease asset amount. Actually, is capital lease asset is the same as the equipment, because that equipment is now not the capital lease asset, but the equipment on their balance sheet with their own title, right? So the equipment amount anyway, the capital lease asset with at the original cost minus depreciation. Oh, I just use the accumulate depreciation. Is much makes sense. Okay, minus the accumulate depreciation. Oh, what I'm doing, I'm so sorry. The original cost of equipment we cannot reduce with accumulate depreciation. I'm so sorry. So the accumulate depreciation is the contra account that reduces the value of this net of this equipment, right? So the equipment minus accumulate depreciation. So 58,916 is net the equipment, net capital lease asset amount. Okay, so we finished up guaranteed residual value, the exercise, and the bargain purchase option. I want you to practice it several times until you get this skill planted in your gut, because that is a very very important exercise that might be coming to the final exams or some quizzes. Okay, so see you next video clip. Bye bye.